Hello, my name is Chris McCauley with the Strategic Planning Group, and it's time for our third quarter update. I won't bore you with the details of the markets this time. Suffice to say, the bond market is flat, the stock market's mostly up, mostly carried by 7 large U.S. tech companies. Other than that, the stock markets are flat. On the Washington front, we survived the budget stalemate earlier this year when we were wondering if U.S. debt would be paid. And then we survived the recent budget stalemate, although Speaker of the House Kevin McCarthy did not. On to the next Washington crisis, which will be who is the next Speaker of the House. It will be settled. We don't know yet at this time who it will be. Looking ahead for investors, it appears the Federal Reserve Bank is nearing the end of its interest rate hiking cycle. The Fed started at 0, and we are now in the mid 5% range. We can now earn a mid-single-digit return on short-term U.S. Treasury bills and safer short-term bond investments. I'm going to show what we call the yield curve to demonstrate what has happened in the past 20 months with U.S. interest rates. Along the x-axis are interest rates, and on the y-axis are the months or years of U.S. Treasury debt maturity term. Looking at the top blue line, that tells us our current interest rates. As you can see, the rates are in the mid 5% range for the short term or less than 1 year U.S. debt. For the 10-year U.S. Treasury term, the rate is 4.8%. When the short-term rate is higher than 10 or 20-year rates, we call this an inverted yield curve. The normal shape looks like the black line on the bottom, and that's as of 12/31/2021. If you look at the 10-year Treasury yield and add 3%, that approximates a 30-year mortgage rate. You can see the big increase since December of 2021. We have not seen interest rates this high since before the financial crisis in 2008. I think the so-called easy money era is now over. It was a period where we enjoyed 3 to 4% 30-year mortgage rates, but near zero return on CDs. I believe rates are normalizing from an extended period where the Federal Reserve Bank intervened to lower both short and long-term interest rates. As investors, this bodes well for bond returns, but does make home buying much more expensive. What we have been doing and will continue to do is invest in both short-term and long-term bonds. The short-term rates give us a nice current return, while if the Fed reduces interest rates in the next couple of years, long-term bonds should deliver a nice return then. I haven't mentioned inflation, but it is down significantly over the last 12 months due to the efforts of the Fed raising interest rates. We expect short-term rates to remain in the mid-single digits until the Fed is satisfied that inflation is tamed. Thank you so much for watching and learning hopefully a little bit about the yield curve and interest rates in America. We do have a brand new website for you to check out. We're very excited about it. The website address is www.spgfinancial.com. Please take a look at the resources page under financial guidance, where we think we have some very relevant articles for you, which will be updated monthly. We also have a link to investor360.com for those clients that use that. Thank you for watching our update, and have a great week.